So, the title of this episode is A Stock Market Divided Cannot Stand. And I truly believe this. Um, I'm in my early 30s. I've been following the stock market, I'd say, for probably a good, well, about 15 years. Obviously, very early on, not really understanding much about the mechanics of the stock market. My degree is in finance and economics. Started to pay a lot more attention in college. Had an internship with what was then Wachovia Securities, and then following the financial crisis was acquired by Wells Fargo, and so gained a better understanding of the mechanics of the stock market, investments, stocks, bonds, commodities, currencies, all that fun stuff. And I continue to educate myself to this day. I would probably say I've been paying the most attention during the last several years, definitely following the financial crisis. And I can say with 100% certainty and confidence that I've never seen a stock market react in the way that this market has been behaving for quite some time, especially over the last few months. Let's just call it the last. Let's just call it the last quarter, really. With the major indices being the S&P 500, the Dow, the Nasdaq, and even the Russell 2000 entering bear market territory for a short period of time, and I mean a really short period of time. This thing has just shot back with a vengeance, spring-loaded. This V-shaped, quote-unquote, recovery in the stock market that's just been going pretty much on a straight line in positive territory for the last several weeks now. How much longer it's going to continue is anybody's guess, but a lot has happened in that time, which is very unsettling to me as an investor and as somebody who is just a general observer of the economy and the stock market. Given the fact that the major indices are comprised of global corporations and a lot of their revenues and earnings are derived from overseas, it makes sense that it can be, and there is to an extent, a disconnect between U.S. stock market indices and the fundamentals of the U.S. economy itself. However, the degree to what is taking place now is just startling. It's shocking to me. It just has me shaking my head almost on a daily basis because this is insanity. It is insane. You have a stock market that drops from its all-time highs in October, September, depending on the indice, mid to late last year for sure. The indices made their all-time highs. Went into correction territory, which is typically defined as a decline of 10%, and then into bear market territory, which is generally defined as a 20% decline. It did not stay down for very long, as I had previously stated. But what were some of the headwinds that the markets faced that sort of put the markets down 20% in a very short period of time? Well, the list is large. It continues. Many of the things have not been resolved, if any of them, and I'm going to devote another podcast to that. There's a list of 30 things that Deutsche Bank had put out for headwinds that the global markets will be facing for 2019. That'll be an interesting episode because there's a lot to discuss there, and that might even stretch over a few episodes, but we'll see what happens there. Some of those issues, though, I will touch on briefly, are the actions of the Federal Reserve, our central bank, our monetary authority in the United States, going from a policy stance and a strategy in transparency and communication to sort of coach along the markets that the Federal Reserve is going to start tightening, which means they're going to start increasing interest rates, particularly the federal funds rate, which is an interest rate that banks use to lend to each other, typically on an overnight basis so they can meet their reserve requirements. Another policy action that the Federal Reserve was going to continue was the process of quantitative tightening, not quantitative easing, which is what has taken place as a crazy and reckless economic experiment the world over for the past 10 years, which in my opinion has given rise to these all-time highs in the stock market that just seem to never end. Or not for long, as we've just seen. We've seen a 20% decline, bear market territory. 6 weeks later, we've gained a significant portion of that back, based off of, you guessed it, the Federal Reserve. They came out and said, whoa, okay, maybe we made a mistake. Maybe we shouldn't be tightening interest rates. And maybe, just maybe, we're not going to continue with quantitative tightening. Maybe, just maybe. Here's what this is, folks. Plain and simple. The stock market is a drug addict. The Federal Reserve is the dealer. The dealer said, I'm taking the drugs away. The stock market threw a hissy fit, just like everybody else in this country. And they got what they wanted. They got another fix. They got another hit from the Federal Reserve. The Federal Reserve wants to be more transparent. The Federal Reserve wants to communicate what they intend to do with the market so as to handhold the markets so stocks, bonds, everything can get quote-unquote priced in appropriately. Well, seemingly to at least some degree that occurred with either the correction or the bear market territory. The markets threw a tantrum. The Federal Reserve said, well, maybe we made a mistake. President Trump threw his own little tantrum, saying he wants the funny money. Obama had the funny money. Why can't I have the funny money? Don't keep increasing interest rates. I don't like it. And so the Federal Reserve, under the leadership of Chairman Powell, changed course and is now in a more data-dependent wait-and-see mode, which, of course, the markets interpreted that as we're less hawkish, more dovish. The Federal Reserve was potentially anticipating 4 rate hikes during this year, probably in the realm of 25 basis points, which would in total increase the federal funds rate by a full percentage point, which would take it anywhere really between 3 to 3.5%, which is still low by historic standards. It's still extremely low. Now, we were in zero interest rate policy, ZIRP or ZIRP, for almost a decade. That has had ramifications that we are going to be paying the price for a very long time. I will get to those more specifically in subsequent podcasts, but the amount of malinvestment that has taken place as a result of this funny money, and that's exactly what it is, it's funny money, placed first into the hands of the banks and then distributed as they seem fit, given to major corporations, then smaller, mid-sized corporations, then it'll make its way down to the consumer. Obviously, high credit first. So the wealthy will get this money first. They will buy financial assets early. Then the money will start to trickle its way down through to the middle class, into the lower class, and then they will also buy some of these financial assets, bid the price up further. The wealthy get wealthier, and the middle class and the lower class don't make out like bandits, as do the top 1%. As legendary hedge fund manager Stanley Druckenmiller, and I like Stanley. I think he's a practical guy. He said, and he said this several years ago in an interview. He said quantitative easing is one of the largest wealth transfers that ever happened in the history of the world. It took the wealth from lower income and middle income people and families, and it transferred it to people such as himself, already a successful billionaire. And I don't demonize success, and I don't demonize Stanley and every other hedge fund manager who was successful, or anybody else for that matter. I would only demonize them or condemn them if they did it fraudulently. I applaud success. I am very much a free market capitalist. And he is absolutely 100% correct in saying that was one of the largest wealth transfers that ever happened in the history of this planet. And it didn't just happen here in the United States. The ECB, the European Central Bank, engaged in this type of policy. The Bank of Japan, the People's Bank of China, they're all doing it. Why? Because all of these markets are drug addicts. All of these central bankers are the dealers. Look at who they work for. They work for the banks. They're enacted by the governments. That's who they're going to look out for. They're not going to look out for you and me. They may say they work for the American people. The question becomes, what American people? Because it surely isn't every one of us. Having low interest rates deprives people who are trying to save money the ability to save money. You put your money in a savings account, you are not getting any type of significant interest on that savings. So clearly those Americans who are trying to save aren't some of the Americans that the Federal Reserve is looking out for. Older people who are on a fixed income are not benefiting by this policy of low interest rates. I will repeat this many, many times over. Inflation is always and everywhere a monetary phenomenon. When a central bank increases the supply of money, it is inflation. Period. The effects of inflation are price increases. That inflation will make its way throughout an economy in a very asymmetric way. Some sectors will get hit right away, others not for a very long time, and all of those things will be to varying degrees. But inflation will eventually make its way through pretty much all sectors of an economy. Again, it's just to what degree. So it's not always when you look at the price of oil that the price of oil is going up, but that the value of the dollar is decreasing because of the inflation. It takes more dollars to buy the same amount of goods. That is theft by another means. It's the silent taxation that people don't vote for. And nobody wants. Except central bankers and governments, because it makes their debts cheaper. Makes their borrowing costs cheaper. We have a financial crisis staring us in the face once again, and this time there is nowhere to run or hide. 2008, 2009, this was very much on the consumer, on some of the banks, on some of the shadow banking industry. it was limited, but its effects were huge. The government and governments around the world were able, to some degree, come in and save the day. Central banks, to some degree, were able to come in and save the day. Now there's nowhere to run. There has not been enough, and there will not be enough global growth to soak up all of this debt. Because you have to understand what debt is, ladies and gentlemen. It is extremely important. It's not pixie dust. It's not fairy dust so we can all fly away. It is pulling future consumption forward to today. I don't have $100 in my pocket. I'm going to go to the bank. He gives me $100. I'm going to go buy something for $100. I couldn't have done it today unless I went to the bank. I might have been able to do it next week if I went and worked and earned $100, but that would have been next week. So that's what debt is. It brings forward future consumption. So the question then becomes, where does all of the future growth come from if we pulled it all forward to today? This is the crossroad that the global economy is now faced with. And when you're a central banker, one of your only tools is to print money. It's as if you're a hammer, everything needs to be nailed down. If you're a central banker, we just print money because that's what we do. That's our tool, that's our policy. Deal with it, live with it. We're making the markets happy. Middle class is getting a shaft. The lower class is getting a shaft. But people who have financial assets, the real people we work for, the government gets lower borrowing costs. All's fine in the world. Until it isn't. And that's what gives me great concern. And that's why this is a stock market that is divided. And because it is divided, it cannot stand. I am by no means a doom and gloomer, but I am a realist. And I'm not going to be lied to. I'm not going to conduct financial and fundamental analysis. I am not going to look at all of the headwinds that face us as a country and as a global economy and say all's well in the world just because central bankers are printing money. In fact, that is one of the main reasons why I am so concerned for everybody. Because there's nowhere to run. Governments around the world have more debt than they did during the Great Financial Crisis. What money are they going to use to bail out companies that go under? They shouldn't be bailing them out to begin with. But that will be some of the political pressure, as it was in 08-09. They don't have the money. Other corporations, the amount of debt that they have taken on since 08-09 is ridiculous. But to some extent, I cannot blame CFOs and CEOs of these major corporations because they have funny money to play with, and their compensation is tied to the performance of their stock. So if I can borrow a whole bunch of money for almost nothing, I can use that money to issue dividends, which investors obviously like. So over time, my share prices may go up because of that. And I can use this easy money as a mechanism to buy back company stock, which reduces the amount of shares that are being traded. Now, that's just simple math. If it's earnings per share, if you have fewer shares, your earnings are higher than they otherwise would have been. So we have been living in a world of financial engineering for the past 10 years now. In my opinion, these share buybacks are going to come home to roost, and they are going to come home to roost with a vengeance. Because it's not as if this was all organic growth, meaning that these companies grew their market share by outcompeting the competition, by having price leadership, by having product or service differentiation, and simply gaining market share in an organic fashion. Now, some of these companies have. I don't want to take this away from companies being successful. Again, I'm not demonizing success. What I am questioning and calling attention to is how much longer can this be sustained? Because in my opinion, the further out this goes, the bigger a fall we will have. So there's not enough money out there for governments to save these corporations. There's not enough money in some of these corporations to save each other if they wanted to. Because who's going to trust each other's financial situation? Very much akin to the financial crisis. Banks didn't want to do business with each other because they all knew that they were all in trouble. Well, I'm not going to give you millions and millions of dollars to bail you out when I'm in a lot of trouble. If I'm in a lot of trouble, I know you're in a lot of trouble, so why am I going to do it? But the government was there as a backstop, and the Federal Reserve was there as a backstop. Given the levels of debt, there's not enough money in the world to backstop these corporations, another financial crisis, and there's not enough money to bail out these governments who have more debt than they've ever had in the history of their existence. And this is the world over, mind you. This isn't just unique to the United States. Japan has been off a cliff for years. China, their entire growth, their quote-unquote miracle is coming to an end. It's not going to be pretty. The Eurozone is a disaster. I will be doing many more podcasts on these topics in greater detail. I don't know how well the European Union and the Eurozone will do going forward. I wouldn't be surprised if the Euro ceases to exist in the not too distant future, given the current economic and political situation that is ensuing in that part of the world, whether it be the yellow vests in France, which has spread a little bit to other countries, whether it's Brexit, whether there's a deal, a no deal, a soft landing, a hard landing, whether it's Italy, now officially in a recession. How long will that last? Will the Greeks be able to grow and get out of their economic mess that still exists and persists? Will Germany, the supposed leader of Europe, the miracle economic engine of Germany, are they slipping? And if they slip, then who's safe? Overheated housing in Australia, in China, in Canada, in parts of the United States, and in some parts of Europe again. It is insanity. We have our auto companies laying off thousands of workers. What do they know? Do they know something we don't know? Because we have a disconnect. This is the stock market divided that cannot stand. We had Google release their earnings, or Alphabet as they go by now, the parent company. They beat expectations and estimates, top line revenue, bottom line earnings. Other components of their company beat estimates. Stock was up today about 2%. They reported after the bell. So after hours trading, it was down over 2%. So they gave it all back. even though they beat expectations, top line, bottom line. Why did it go down? Because their costs have started to increase. Now, obviously, none of you know me that well, but this is something that I have been contemplating for a long time, and maybe this is the gopher starting to pop his head out of the hole a little bit here, as the next concern that I had as far as how these companies are going to manage their costs going forward, because you have the financial engineering that's been taking place, but if costs start to rise, now your gross margins are going to start getting squeezed. So the question then becomes, where does the earnings come from to sustain the level of earnings that this market has gotten used to because of all the financial engineering? If you have a slowing global economy and national economy, where does the growth come from? Good question. I don't know. Where does it come from? More money printing, I guess, so more financial engineering can take place, which creates more debt, which pulls even further future consumption forward until people say, enough, stop, I can't take it. Stop doing this to me. Stop sending me more applications for credit cards. I can't do it, and I can't pay 18%. So please stop doing it. You can't make people continue to buy things they don't need and things they can't afford just so GDP can look good and you can pat yourself on the back. It's not how it works. I don't want to be a part of an economy that functions like that and thinks that that's rational and prudent. That's the reason why we have $22 trillion in debt as a nation. That's why we have just as much, almost as much housing debt as we did pre-crisis. That's why we have $1.5 trillion in student debt. That's why we have over $1 trillion in auto loan debt. That's why we have over $1 trillion in credit card debt. Does any of this sound sustainable to you? This is not going to end well, because it's only a matter of time before everybody says, I can't. I can't afford it. I can't do this. I need to start paying off my own debts. All of the growth that may happen from a lot of these companies, and of course it's individual to these companies, how much debt they have on their balance sheets. Some companies have pristine balance sheets and do a very good job protecting it and growing their companies. Others not so much. So, but you don't need a whole slew of companies or multiple sectors of an economy to cause a lot of damage, as we witnessed only a decade ago. So if the analysts and investors are expecting companies to maintain the level of earnings that they have had over the past decade, yet these debts are now coming due, somebody's going to get disappointed. Because some of these companies are so indebted that their future earnings are going to have to go to pay for all of this debt, especially in an environment where you have increasing interest rates. Now, as I said, of course, the Fed has paused. Will they reverse course and lower interest rates? That remains to be seen. That's a possibility in my mind. It will be reckless. But that hasn't stopped them from being reckless before, so that doesn't mean anything. They will very easily reverse policy, in my opinion. Now, is that going to happen at the next Fed meeting? Probably not. But maybe later in the year, especially if things don't get better, then they'll contemplate doing it. Now, what's going to box them in is if this stock market continues to rise, hits new highs, then they're going to say, well, the market shouldn't have a temper tantrum. We became data dependent. We put these things on ice. Now the market's rallied big time. Maybe it touches, it re-hits its all-time highs. Maybe it blows through them. and makes new all-time highs amongst the major indices. Then they might get boxed in. Time will tell. We'll see. But we have to pay attention to this because it's very important. These are market makers. These guys move markets with headlines. It's something that upsets me to my core because I am a free market capitalist. A presidential tweet, a news conference from a Federal Reserve chairman are not supposed to move tens of trillions of dollars worth of financial assets to the degree that they do. We, as participants in the marketplace, are supposed to move tens of trillions of dollars worth of financial assets. That's too much power in the hands of the few. And we wonder why we have so many problems. We will continue this conversation. Thanks for listening. Take care. Godspeed.